The Fed has decided to raise interest rates by 25 basis points, not 50, not pausing, 25. And this was incredibly interesting because over the past week, as I've analyzed what the Fed is going to do, it seemed obvious, just like it seemed obvious to lots of different people, that the Fed was going to do 25 over 50. Now, the main reason why people thought it was going to be obvious that the Fed was going to do 25 over 50 is because of the banking collapse that we had. When Silicon Valley Bank collapsed and basically caused the contagion that was able to be contained within about 3 days, but led to the collapse of Signature Bank of New York, led to the almost collapse of First Republic in San Francisco, that then got basically bailed out by other banks by throwing in deposits. And now that company's doing okay. It was at 140. Now it's at $15, but at least the stock's not gone. And then also the Credit Suisse buyout by UBS. So many things happened that would lead you to think that if we continue to further tighten rates at a substantial level, along with the quantitative tightening that we're doing, it would just be a recipe for a disaster, and it would be going too far too quickly, especially given the 10-year in the Treasury in terms of the bond market started to come down precipitously from like 4.5% down to 3.68%. And so if the inversion stops inverting as much as it was inverting in regards to bonds and stocks, and banks are starting to theoretically collapse and people are starting to take their money out of these regional banks and put them into the big four, you don't want to make a harder economic environment for consumers to do anything. I mean, that's why we gave stimulus checks back in 2020 during COVID, at least in the United States, was because we had so much business activity that shut down overnight. 6.8 million people lost their job in a month, that you need people to start spending. You need people to start building businesses again. You need to encourage and literally stimulate the economy. And so when that didn't happen, ultimately you get to the point where you have to do something dramatic. This is not the case. Now we have inflation at a reported 6%, and the Fed needs to try to get it down to 2%. Jerome Powell was very, very clear that until we get inflation down to 2%, nothing's going to change. He also said in the press conference yesterday at the FOMC meeting that there is likely not going to be a cut on rates this year. There might be a pause. He even said the Fed was thinking that there would be a pause before we get into raising rates. So they did consider and at least pontificate the potential of a pause before deciding for 25, but that would be very decisive. 50 would also be very decisive, and the Fed does not like to be very decisive, so they went with 25, kind of the safest option for them to go through. And now it's more likely than not we might get another basis point hike over the next 6 months. But if the Fed does decide to pause over the next couple of months, like Canada, that paused at 4.5, I believe we're at 4.75 right now, that would probably be, at least in the Fed's mind, the right course of action. Let's take a look at Jerome Powell actually speaking about the potential for a soft landing.
I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
It's very interesting when Jerome Powell says that there's a potential for a soft landing. Obviously, 25 basis points was their definition of potentially going soft on the market. But a soft landing would imply that millions of people do not lose their job. Inflation comes down more naturally than not by not continuing to hike up interest rates at a dramatic level. And that earnings for companies within the stock market, right? Apple, Google, Amazon, Facebook, you talk about some of these big companies, don't crap the bed when it comes to the earnings. Remember, the S&P is still trading at around 17 to 18 times its PE. Historically, it's around 14 to 15. So if you just look at that metric alone, a $399 S&P is going to have to come down a little bit if we want to get to the norm. If that's not going to happen, and again, the only way that happens is if a bunch of companies show bad earnings. And Q4 2022 was pretty good earnings. I mean, Facebook put up $32 billion. Google put up $70 billion. I think Apple put up more than 100 billion. Amazon put up like 125 billion. So when these companies are putting up these types of numbers, and yes, growth is not amazing, but it's also not bad, I mean, it's like meeting, if not exceeding some level of expectations, then it's really hard for the market to decide that we're just not going to buy these stocks, and we're not going to try to put our money in a place where we can get, a 7 to 8% return for the year versus bonds that are giving us maybe 3 to 4%. A soft landing to me would require inflation to come down on its own in order for unemployment to not have to rise. So the Fed says they want to get unemployment up at least 1%, right? So it's at 3.6 right now. If they get it to 4.3, 4.4, that would be another million jobs. And the labor markets are very tight. Jerome Powell also talked to you about yesterday about how those labor markets being tight makes us scared and worried for trying to get inflation down to 2%, because it's really hard to get inflation down to 2% when everyone has a job and everyone's taking the money they get from that job and spending it in the economy. If you get money from a job and you start spending it, there's going to be some inflationary effects, especially if inflation is already so high. The best way to reduce that is by people not having jobs. As sad as that sounds, that is the reason why Jerome Powell fought with Elizabeth Warren, because, Warren from an ideological political perspective doesn't want people to lose jobs. And Powell from an economic macro perspective and, purely logical perspective is like, I don't know how else we get rid of inflation unless that activity stops. And so that idea for a soft landing only happens if the Fed starts to reduce interest rates, cut them back. And the only way they start to cut them back is if they see inflation fall on its own. Now, Trueflation.com says we're at 4% inflation, not 6% inflation, which means technically we may start getting down to 2% maybe this year, maybe early 2024. And if that happens and, the S&P doesn't collapse down to 3,200 or 3,100, as a lot of analysts on Wall Street are saying, then we have absolutely, even if we get to 360 or 370 on the S&P, I think we've avoided a hard landing. That is the definition of a soft landing for me. But the question is if we're actually going to be able to get there. And what the Fed did yesterday was an indecisive approach that basically has one foot in the door, one foot out the door. And I believe CPI numbers next month are going to matter tremendously to decide if we pause or if we do another 25. If I had to answer right now, I think we pause. And as inflation comes down, as earnings start to show for these companies, and earnings are not horrendous, there may be a world in which we have a market that starts to decide to go up again. But it really depends on how the Fed decides to deal with inflation and if it's actually coming down in their estimates, and if earnings from companies are showing that growth is not stalling. And, we see a lot of layoffs from Facebook, and there's a lot of ways to interpret that. The Meta layoffs are like, well, they're becoming more lean and therefore they're saving more money. The Amazon layoffs are like, well, why are they firing 9,000 jobs in their highest growing departments like Twitch and advertising? And so there's a lot of mixed signals going on in the market, and we really don't necessarily have the answer to this. But all will be determined, I believe, next month when we get CPI data, unemployment data, and then how the Fed chooses to react to that data based on if they pause interest rates or if they don't pause interest rates. And we'll see what the Fed decides to do.